We're joined by fantastic speakers, led by Shanti Divakaran, who's a senior financial sector specialist at the World Bank's Financial Competition and Innovation Global Practice. Shruti, who's the head Shruti Chandrasekhar, who's the head SME Ventures and Startup Catalyst at IFC. Ashenafi Alemu, who's a co-founder of Zoskalis Partners. Sam Akianu, advisory lead for SME Ventures at IFC, and Mesfin Tafese, who's principal attorney at Mesfin Tafese and Associates. So what we're looking to do this afternoon is to have a presentation by Shanti, giving us findings from the report. She'll take us through 20 minutes of a very interesting presentation. And then we'll have Sam Akianu take over a panel discussion where Shruti, Mesfin, Alemu, and Shanti will discuss what the reality on the ground in Ethiopia has been and what the future holds. And then after that, we look forward to having you all participate and give us whatever questions and thoughts you have on doing deals in Ethiopia. At this point, I'd like to welcome Shanti to take over and lead us through the presentation. Welcome, Shanti.
Thank you, Esther. So I'll just, as I wait for the slides to come on, thank you very much, everyone, for joining this webinar. I really appreciate this opportunity to present the findings of our report to you on Ethiopia's private equity and venture capital ecosystem. I will be presenting this on behalf of our team, which included Patrick McGuinness, Mesfin Tafese, and his colleagues at the MTA Ethiopian law firm. Mesfin, as Esther said, is on this panel, and Austin Hubert. This report is actually the fourth in a series of regulatory assessments that have been initiated by the IFC Ventures program headed by Shruti. So with that said, let me move on to the agenda. I'll just wait a minute for the agenda to come on. Thank you, Esther. So next slide. So our next slide is the agenda. It's fairly simple. I'm going to first take you through the context within which we conducted this study in 2018, 2019, and then discuss a little bit about the changed context that we all find ourselves in right now. And then I'll take you through the findings regarding the private equity and venture capital market in Ethiopia and who the players are in that market. And then lastly, I'll be taking you through the private equity and venture capital regulatory environment in Ethiopia and what are the legal, regulatory, and tax influences on this sector. So next slide. So first, I know this is a broad audience, so I thought it would be good for us to get on the same page in terms of context. What is private equity? As most of you on this webinar probably already know, it's an asset class in which investors buy equity or equity-like securities, quasi-equity securities in companies. These securities are not publicly held, they're privately held. In exchange for that capital, private equity funds take a minority or a majority ownership stake in the company. And private equity funds hold these securities for 3 to 7 years with the idea of generating value in that company and expecting profits when they exit that investment. So when we talk about private equity, we're talking about an umbrella term that encompasses a range of investment strategies. This includes growth equity, which is expansion capital for established companies, buyouts, which are basically when private equity funds take controlling stakes in companies, and then venture capital, which is basically financing provided to early stage, high potential companies. In developed markets, it also usually means companies that are in the high-tech industries or have scalable technology-enabled business models. Next slide. So why is private equity valuable, and why is it that we talk about it in the development context? The reason it's valuable is because it has a capital plus model. That is, it provides financing for companies that need it, and in addition provides capacity building that actually generates value in the company. Private equity funds are also able to transfer knowledge and technology and thus bring innovation to markets. They usually bring higher standards of conduct to their investee companies in terms of environmental issues, social issues, governance standards. They can also act as a boost to capital markets because one of the exit routes for private equity funds is through the stock market, public markets. So that is why private equity is valuable from a company perspective. From an investor perspective, private equity funds provide diversification of investments and they provide the perspective of attractive returns. Next slide. So we just talked about what private equity is and why it's valuable to get on the same page. Now, talking about the objective of this particular private equity and venture capital assessment. We conduct these assessments in a number of different countries. As I mentioned, IFC SME Ventures itself has initiated four of these assessments. And the premise that we undertake these assessments is basically that growth in private equity and venture capital investment in a country is broadly favorable for economic and social development, and brings a lot of benefits like for SMEs, for job growth. So our goal in conducting these diagnostics is basically to help the government understand the market structure, its players, understand what is driving the market and what is impeding the market, and very importantly, looking at the rules at play that the government controls, which is the legal, regulatory, and taxation drivers and impediments. And then we synthesize this sort of diagnosis from these three aspects, and then identify areas of reform that the government could consider. Next slide. So that was the context under which we started the study in 2018, 2019. And of course, as we all know, the context has changed drastically in the last 7 months. The pandemic has shifted the course of economic development globally and priorities for governments. The World Bank predicts that sub-Saharan Africa will experience negative 3.3% growth in 2020, and that the region will enter its first recession in 25 years. Ethiopia is actually one of the few countries on the continent where economic growth is expected to slow down considerably, but still remain positive. So it's a fair question to ask, given this context, whether private equity and venture capital, talking about private equity and venture capital is still relevant in this kind of a context. And our answer is yes, it is important and relevant to talk about private equity and venture capital, specifically because it presents an important economic solution that can be very helpful in the COVID environment. So private equity and venture capital funds can present a vital lifeline for companies that have been under tremendous upheaval and stress during the crisis, with prolonged periods of strain on their cash flows and facing equity shortages. Private equity and venture capital funds from an economy perspective are also the economic agents that through their professional management can efficiently allocate and reallocate economic resources based on the changing patterns as a result of the crisis. And private equity and venture capital funds, the ownership model that they have allows for influence in directing the strategy of their portfolio companies. And basically, as professional managers, they can work with their investee companies to read market signals, help them transition through the crisis, adopt new technologies that are needed, reconfigure their business model to address changing patterns. So all of these All of these factors means that private equity and venture capital, that it is very relevant to talk about private equity and venture capital in the COVID environment. And it is very relevant to also talk about resolving legal and regulatory barriers to private equity and venture capital in this environment. So next slide. We are going to now talk about Ethiopia's market specifically. Next slide. I'll start by giving you a summary of our findings on the market. Basically, the private equity and venture capital industry in Ethiopia is over a decade old. It started in 2008 with SGI Frontier investing in Ethiopia. It consists entirely of offshore funds. The World Bank estimates that over $650 million has been deployed in Ethiopia through roughly 30 private equity and venture capital investments. We also estimate that the combined assets under management of local Ethiopia-focused funds and regional funds investing in Ethiopia is over $400 million. There have been a few large buyout deals in Ethiopia, but barring that, the private equity and venture capital investments in Ethiopia tend to focus primarily on growth investments, providing capital to SMEs, and the average investment size is roughly $6.5 million. The focus of private equity and venture capital has been primarily on two sectors, food and agriculture and manufacturing, which are also strategic sectors that are promoted by Ethiopia's investment promotion agency, the EIC. Unsurprisingly, private equity and venture capital penetration remains low, as it is in a lot of developing countries. But since 2015, the industry has developed a much deeper local presence in Ethiopia. Next slide. So now let's talk about who actually is investing in Ethiopia. So this slide is showing you the private equity and venture capital funds that have invested in Ethiopia by the type of investment strategy that they've used. So you'll see on the left that, as I mentioned, there have been a few buyout deals in Ethiopia, like by KKR or Sun Capital. But the dominant strategy used has been growth. So there are a number of private equity and venture capital funds like 8 Miles, Ascent, Cepheus, Zoskalis, etc., who are in that category. Ethiopia also has a budding venture capital ecosystem. So Novastar Ventures set up shop in Addis Ababa. It is a venture capital fund manager that focuses on scalable businesses that are targeting the base of the pyramid. And then Ethiopia has what are called fundless sponsors, which basically are firms that that look for acquisition targets and then raise capital on a deal-by-deal basis. So that's 54 Capital and Renew LLC that are shown at the bottom of this chart. Next slide. So the next slide, this chart, it looks very similar, but it's actually showing you now private equity and venture capital funds by geographic focus. So what we found is that there are 3 main categories of private equity and venture capital funds in Ethiopia by geographic focus. There are ones that focus exclusively or primarily on Ethiopia, and that includes Zoskalis, Ash is on the panel with us today, Cepheus, Ethiopia Investment Limited, etc. And then there are regional funds that have invested in Ethiopia, but may have maybe headquartered in Kenya, may also be investing in Tanzania, Uganda, etc. So that includes Novastar, as I mentioned, 8 Miles, Catalyze, etc. And then there are funds like the buyout deals that have invested through global funds in Ethiopia, like KKR, Duet Group, Sun Capital. Next slide. So we just talked about, we did a quick market recap and who are the funds in the market. One very important player in these markets is usually the investors that are backing the private equity and venture capital funds. And in Ethiopia, this is predominantly development financial institutions and foreign family offices or high net worths. So DFIs, development finance institutions, are active generally in developing markets, seeding private equity and venture capital funds. So they're also active in Ethiopia. They include EIB, Norfund, CDC, the IFC. And basically what they look to do from the development point of view is to provide a demonstration effect that can help bring commercial investors as well. Ethiopia also has high net worth individuals and family offices from the US and Europe, and high net worth individuals from the Ethiopian diaspora, and from East Africa as well, that are investing in these funds. Some of the regional funds, for example, Ascent and Catalyze, that are headquartered in Kenya, have also been able to diversify their investor base by mobilizing capital from Kenyan pension funds. And there are also private sector investors like JP Morgan Chase and AXA Investment Managers that have invested in private equity venture capital funds that are investing in Ethiopia. So what is important here to note is that local capital, local domestic institutional capital is absent from the asset class, and we'll talk more about why that is later. Next slide. So this slide, we're looking at what is actually driving this market or impeding the market from just a market perspective before we look into the legal and regulatory issues. So what is driving this market and what private equity and venture capital funds find attractive is that Ethiopia has a large population, over 110 million people. It's the second most populous nation on the continent. It's strategically located in the Horn of Africa. Ethiopia has experienced rapid economic expansion in the decade before COVID hit. And in the last couple of years, there's been a change in the political climate and a promise of economic reform. So the government is currently implementing phase 2 of its growth and transformation plan. It has implemented a number of institutional and legal reforms that hold promise for investors. It plans to liberalize sectors dominated by SOEs. So for example, there has been discussion around privatizing Ethiopian Airlines. There is also discussion around creating a stock exchange in 2020. So these are all the factors that are driving the market, but there are also a number of impediments in the market that are discouraging for investors. So the primary one is this persistent acute shortage of foreign currency in Ethiopia, which affects foreign investors and private equity and venture capital funds, and basically influences the whole investment process. So for example, it determines which sectors private equity and venture capital funds would consider investing in. So that usually they favor sectors that are resilient to Forex. They favor, for example, export-oriented companies or companies that don't require getting raw material or input from abroad. This shortage of foreign currency also influences and dictates the timing and predictability of repatriating gains by private equity and venture capital funds. The other issue is that Ethiopia has an underdeveloped entrepreneurial culture. It ranks poorly on the ease of doing business. At the Doing Business rankings of the World Bank in 2020 ranks Ethiopia at 159 out of 190 economies. There are the issues like slow internet connectivity, English not being widely used, which can be problematic for fund managers. And talent recruitment is difficult. Not only is local talent not always available, but recruiting international talent can be difficult because labor laws can make it challenging. So for example, recruiting an international, extending a work permit to an international recruit would require providing proof that there is no local individual that can take that particular opportunity, job opportunity. And then exits can be challenging. As I said, there's no stock exchange, although there are discussions of that coming up. Next slide. So we've now talked about the market, who's in the market, the players in the market, what the market looks like, and the drivers and impediments in the market. Now let's look at the regulatory environment for private equity and venture capital. Next slide. So, a quick summary of what the legal and regulatory environment for private equity and venture capital funds looks like. Ethiopia currently does not have a regulatory framework for private equity and venture capital. So basically, this sector is not recognized by the Ethiopian Commercial Code or Civil Code. So all private equity and venture capital funds operating in Ethiopia, investing in Ethiopia, are domiciled offshore and operate in Ethiopia under its FDI regime, its foreign direct investment regime. So what happens then is that the regulatory influence over these funds operating in Ethiopia is fragmented, it's dispersed across several entities. Usually what happens is that the securities markets regulator is the one sort of supervising private equity and venture capital funds when there is a regulatory framework. In Ethiopia, there's no capital markets authority. So the entities that exert some control over or exert some influence over the ecosystem in which offshore funds operates include the Ministry of Trade and Industries, which registers businesses and issues business licenses. The Ministry of Revenues, which is the tax authority also in Ethiopia and determines it collects taxes. The National Bank of Ethiopia, which licenses banks and financial institutions, and very importantly, determines the terms and conditions of foreign exchange transfer into and out of the country. The Investment Promotion Agency, EIC, which issues investment permits and registers all foreign investment in the country. The Competition Authority, which controls anti-competitive practices and approves mergers. And then DARA, which is under the Attorney General administratively, and they notarize company bylaws and key transaction documents. So this in a nutshell is the environment in which private equity and venture capital funds operate in Ethiopia. There has been promising recent regulatory change in Ethiopia. So this has included the new investment proclamation, which has provided a new investment regime for private equity and venture capital funds. Ethiopia has also ratified the New York Convention, which basically means that Ethiopia must recognize and enforce foreign arbitral awards made in other contracting states. And this is important for private equity and venture capital funds, which often use arbitration as a mechanism for dispute resolution. Next slide. So what we looked at in that first slide is, a quick summary of what that ecosystem looks like. And now I'll just give you a quick list of what are the key issues that we observed in terms of legal, regulatory, and taxation factors. So let's look at it in terms of the life cycle of a private equity and venture capital fund. So first, in terms of mobilizing capital from domestic institutional investors, as I said earlier, this the case, there's no local capital investing in that asset class. One of the issues is that given the scarcity of Forex, it would be impractical for the central bank to permit institutional investors to invest in offshore private equity and venture capital funds. But there's also a lack of clarity in terms of guidelines, investment guidelines for institutional investors. So for example, the Ministry of Finance has not specified if pension funds are permitted to invest beyond treasury bonds. Insurance companies can potentially invest in the asset class, but they generally invest in bank deposits and treasury bonds. And bank investment guidelines issued by NBE's directives do not specifically refer to private equity and venture capital. As I mentioned, Ethiopia now has a new investment regime with a new investment proclamation in the last few months. This has meant a policy shift and a much more open approach to foreign investment. So previously, under the previous regime, there was a positive list of sectors that foreign investors could potentially invest in. Now that has shifted, and it's changed to now a restricted, a negative list of sectors that foreign investors cannot invest in, but everything else is open. What that shift has meant is that the power, transport, and logistics sectors, for example, have opened up now to foreign investors, but banking and insurance, etc., still remains restricted. The other thing that has remained the same between investment regimes is that offshore private equity and venture capital funds have to invest a minimum capital of $200,000, up to $200,000, which can hinder investment in SMEs. Ethiopia's domestic intellectual property regime is robust, so trademarks, for example, are protected in the domestic regime, but Ethiopia is not party to international treaties on IP, which can be of concern for private equity and venture capital funds with respect to cross-border transfer of technology and trademarks. The Competition Authority of Ethiopia has to approve even minority investments from private equity and venture capital funds if the target company has capital over 30 million Ethiopian birr. And that's because of a definition issue around change of control. Next slide. One of the key issues has also been a lack of institutional capacity in terms of the entities that interface with private equity and venture capital funds. So, for example, private equity and venture capital investments in a company trigger amendments to the investees' constitutional documents. And in turn, that requires mandatory notarization by the public notary, DARA, that I mentioned earlier. And the public notary's lack of capacity and understanding of private equity and venture capital can result in challenges to those amendments and resulting delays. The Ethiopian Commercial Code was enacted in 1960 and has not undergone any comprehensive reform. So there are some issues related to the commercial code that can bear influence on the ecosystem. So, for example, the ECC does offer minority protections, but does not offer best practice exit structures for private equity and venture capital funds like tag-along rights or drag-along rights that are often used by them. The ECC also doesn't require a board of directors for private limited companies, only for share companies. And most companies in Ethiopia are formed as private limited companies, which means that there is a governance gap that private equity and venture capital funds may not be comfortable with. Quorum and majority rules in the commercial code are written inflexibly, and there are no rules to resolve deadlock situations. Now coming to the NBE and and Forex rules. So the NBE, which is the Central Bank of Ethiopia, sets Forex allocation priority, and that basically determines which sectors get a priority to receive foreign currency, and therefore which sectors are attractive to private equity and venture capital funds for investment. If offshore private equity and venture capital funds would like to provide debt to investees, they have to get NBE's approval. And that approval is more likely if the borrower itself can generate foreign exchange. So export-oriented companies are likely preferred. And then in order to repatriate repayment of foreign currency denominated loans, again, NBE's approval is required. And the last issue that I'd like to mention is taxes. So Ethiopia has a high capital gains tax of 30% compared to 5% in neighboring Kenya and 10% in Nigeria, which changes the competitive positioning of Ethiopia when it comes to exiting investments. And Ethiopia only has 12 ratified and currently active double taxation avoidance agreements. So these are basically bilateral treaties between countries that ensure that cross-border investors don't bear a tax burden in both their country of residence and their the country of investment. And Ethiopia currently has a very small list of countries with which it has these bilateral agreements. So with that, I'm going to stop and turn it back to Sam. Thank you very much for your attention.
Thank you very much, Shanti. That was a very good exposition of what is a lot of very good work done by you and Mesfin and other associates on the ground. At this point, would like to unwrap this a bit and just go through a few questions. We encourage the participants to also jot down a few questions, share them through the chat, and we'll do as much as possible to go through as many of them as possible. So let me start with Mesfin, who basically represents one of the legal firms, Mesfin, Tafesi and Associates, that worked with Shanti on this report, and delve a bit into the new regulation. Shanti had mentioned in her report the proclamation. It is now a regulation as of September 2020. And Mesfin, whether you can help us understand, both the trajectory and the momentum of the regulatory reform and how it will shape PVC, the private equity and venture capital private sector operations in the country going forward. In particular, who are going to be the champions to take what is coming out of this report forward, and is the new regulation targeted enough, the new regulation that was passed in September, targeted enough to enable a boost to the Private Equity and Venture Capital Association? Mesfin.
Thank you, Sam. Hello, everyone. I think it's important to look at the overall context when one looks at the investment regulation in the proclamation. Of course, its parent legislation is a proclamation, which was enacted earlier. And both the 12 of them together govern the investment regime. And by way of context, the regulation is, the investment regulation is part of a process, result of part of a process that started back in 2018. If participants recall, the 3 months, February to April 2018, were critical in that a change occurred, a political change occurred, and a new prime minister was appointed actually in April 2018. And one of his first declarations were the new economic measures, including privatization of key industries, which Shanti referred to. Of course, at the start, the list of these private key industries was long, and now probably focusing on Ethio Telecom currently. And of course, there was also a very big initiative within the Prime Minister office to improve Ethiopia's ranking of the ease of doing business by looking at key impediments. And that actually was very effective in driving the investment proclamation in the regulations as well, to come out with the speed and the pace at which they were able to come out. So you have, as part of that initiative, you see also Ethiopia's resumption of the WTO accession process. You see the immediate amendment of the commercial registration and business licensing key legislation to remove certain key problems. And you see also the signing and ratification of the African Continental Free Trade Agreement It's all part of this. And of course, interestingly, also there was a National Legal Council which was mandated to look at laws that need to change to promote the new economic thinking, which was under the Attorney General Office, which is still playing a critical role in pushing the legislative agenda forward. Mention was made also the ratification of the 1958 New York Convention, the new movable security rights proclamation, the amendment of the labor law, and opening the financial sector for Ethiopian diaspora. All of this needs to be seen in context. So focusing on, and also in the pipeline, you have the draft commercial code, which was referred in the report, being right now, it's submitted to the Parliament for amendment, which referred it to our standing committees. So it's almost at the verge of being amended. You have a draft capital markets legislation being circulated around. You have a draft startup business regulation proclamation, which is all part of this. So just focusing on the investment proclamation and the investment regulation, particularly the investment regulation. The investment regulation embodies key principle, which was embodied in the parent legislation, which is a proclamation. As was indicated, all areas of investment have been opened now for foreign investors. That's exactly how it's stated. Interestingly, this proclamation sort of goes back to previous approach, the approach adopted in previous legislations. Ethiopia so far had 4 investment proclamations since 1991, and all of the 3 before the last one took that negative list approach. But so the current legislation sort of took us back, and also it eliminates the exclusivity of the sector for government intervention only, and at the same time maintains the minimum investment threshold. And in terms of focusing on PEVC, I would say really the investment regulation is not really sufficiently addressing, or is not focused on the PEVC industry in particular. But of course, it has definitely changed certain existing, provisions of the previous legislation, which have direct impacts on PEVC, I would say. And probably, the first thing, if you look at the existing investment regulation, one thing it did is it changed the administration of investment from the Ministry of, it took it away from the Ministry of Trade and Industry and brought it to the Ethiopian Investment Commission. Most PE funds comes through brown field investment through the ministry. They used to come through the Ministry of Industry, but now they are coming through the AIC, which is a positive development, I would say. And interestingly also, the 200,000 up to 200,000 US dollars limitation threshold for investment by foreign investors has also been modified in situations where new investors buy shares from existing investors. So the threshold, that's a huge development. In the past, I remember a number of investment transactions really finding a way to meet this threshold, while the investment need is much less than the threshold. So you have one important change in that respect. So this I would say is basically the change, the key change that may help the industry in particular. And of course, one can mention also the expanded work permit and visa rights in the new law. Now, especially certain professions, certain like the chief executive officer, the chief operating officer, and the chief financial officer. All of these are specifically named as job positions which can be procured, which expatriates can be recruited directly from abroad. And also one additional feature I would want to highlight is, as was mentioned in the report, PLCs, private limited companies, do not have board of directors. So normally some investors convert these PLCs to share companies just to have board of directors. And when they do so, they will be asked, they put it in the board individual shareholders, because under Ethiopian law, a board member should be a shareholder. So if a board member should be a shareholder, and if the shareholder is foreign, then the minimum threshold will be triggered. So just to avoid that, the regulation introduces an exception to the threshold when PLC converts to share company. There is also an expanded definition given to the concept of capital as a different approach. Now it includes not only cash or in-kind contribution, it includes property rights, intellectual property, other tangible and intangible assets. So all this, I would say, impacts the industry positively. But bottom line is, I don't think it has been targeted to accommodate the sector in particular.
Okay.
That's my
thank you very much, Mesrin. That gives us a very good background to see progress, to see that the things are happening at the regulatory level, and also things are happening in the private sector to begin to move things forward. And we look forward to this as we go forward. Let me move to Ashanafi Alemu, who's partner at Zoskalis and who's actually actively investing in the Ethiopian market. And Ash, I guess, tell us a bit about, Shanti spoke about the difficulties, the ranking of Ethiopia in doing business. Tell us a bit about what you're facing in three broad categories, and mindful of time, so let's be brief so we can go through the other things. But basically, one is in converting deals, pipeline deals into portfolio companies, investments. Two is in when you do convert them into portfolio companies, what are some of the things that you face? And then three is around, of course, the area of restricted investments, the opening up of restricted investments currently, and how that helps you as you go around. I think you may have two devices on, so there's a bit of feedback.
1 second.
Yep, thank you.
Better now?
Yes.
Okay, great. Thank you very much, Sam. Thanks, Shanti, for a great presentation. So how many minutes do you say I have for answering these questions?
You have about five minutes.
Okay, great. 5 minutes is good. So regarding pipeline, I think what is interesting is that, private equity firms at the end of the day don't need to invest in hundreds of companies, right? So in a round of 2 funds, maybe we need to invest between 16 to 20 companies all in all. And that's over an investment period of 10 years, which means that every year you might do 1.5 investments or maximum 2 investments. And then over a course of 5 years, a company can actually be born and grow to become an SME that we can invest in. So I think our experience is definitely quality deals are not easy to come by. I guess that's the same across Africa. And the particular restrictions, for example, we would love to do retail businesses, anything that has to do with supermarket chains or food chains. or anything else, but we can't do that. So there's definitely a notch harder. It's a notch harder with getting quality deals in Ethiopia compared to the rest of Africa. And in particularly, the big one is, if you see, most private equity capital in Africa has gone into financials, so banks and insurance companies, which we have not been able to invest in so far. And there are some rumors that this might change, just with the spirit of the opening of the industries that that you guys were talking about earlier. So yeah, I think, but all in all, to be really honest, getting deals is not the hardest part of doing private equity in Ethiopia, in our view. Of course, you need to be on the ground. You need to know, what you're doing, and you need to have a good network and so forth. Probably that gives us an edge. But if I could categorize the number of challenges one would have investing in Ethiopia, I wouldn't say deal flow is the number one problem. I think, this is what I can say. In terms of another important thing around pipeline development is, of course, the ecosystem, right? So the investment ecosystem, and I think we were, for example, a bit lucky. Mesfin can correct me if I'm wrong, but I think Mesfin had, for a long time, been working with SGI before we came in, which meant that he actually had some experience advising private equity transactions. But I'm sure by the time SGI came in, they had probably nobody to help them, or nobody on the ground who had actually done any private equity transaction. So, but still now there are very few companies. I think I can just think of 2 companies that can actually do the type of work that Mesfin has been doing with us on the legal side. So that's a challenge for sure, and it's a challenge for both us, but also for the portfolio or the pipeline companies that want to engage with us, because if we work always with Mesfin, and how can he be so neutral when he's working for somebody else local we give him a job a month, and then a local company that comes for his advice, is he going to be biased? I'm sure he's not going to be biased, but they would have those kind of fears, right? So that part of the industry needs to develop, and it's the same on the financial side as well. I think stuff like registration, company registration, competition authority, and so on. These are, for me, I have, when we do business, in a country, you have 2 broad categories of challenges. Some of them are very predictable, and the others are unpredictable. And these challenges for me are in the category of predictable, right? So I know exactly how long it takes to register a company. I factor that in my process. So what I tell the team here is that I think since about a year and a half ago, I never want to hear problems about registration, because we know that it takes time. We know that it's complicated. I still have not understood how you actually register a business in Ethiopia, because you have so many entities you have to go to and so forth. But that's a predictable problem. So I actually I beg to defer that, for example, doing business rankings of the World Bank put so much weight on registration, because there's so many other things you need to plan for entering a frontier market like Ethiopia. A 2-month registration process cannot be the biggest impediment, as long as you know what you're doing. So these are not things that worry us too much, I would say.
Okay, thanks, Ash. And if we move to the portfolio, and mention has been made of the difficulty in getting foreign exchange, is it an issue? How does that affect you and your invested companies getting access to inputs that they may have to import?
Yes, I mean, this is a problem in Ethiopia, and when you invest in Ethiopia, you need to know that this is a major problem, and you need to have some idea of how you're going to solve this problem. So we use a combination of models to solve that problem, but of course it might not be applicable to everyone, right? So the combination of solutions that, first of all, you need to understand the problem. The problem is not that you cannot convert your birr into dollars. The problem is that you don't have the liquidity. So the banks don't have the liquidity for it. So there is a direct FX related strategy, which is to get as much dollars as possible from the banks by having better relationship with the banks, by using different schemes like suppliers credit. For example, suppliers credit is a good scheme that we've been using, because what it does is, instead of just asking banks to give you $500,000 today, you're asking them, can you pay $500,000 in about 6 months from now? And that they can plan for. It gives them good margins and they can plan for. So when you have a liquidity problem, foresight is very important to plan for the banks to plan. So we've been using that. And the other thing is also using our own investors' dollars, or the company's dollars to import raw material to bridge the gap when there is no supply. But a whole other thing is operational. So operational solutions that actually reduce your dollar needs. So what we have actually understood is that if you need about $6 million a year to run your business, for example, it's much better to ask your bank to give you $500,000 every month than asking $1.5 million every quarter. Because for them, it's when you come to the bank asking for 1.5, it is at that point in time they need to disperse 1.5. It would be a lot easier for them to disperse $500,000. What that means is that you almost need a just-in-time, raw material sourcing program, basically, and that has been in some cases difficult in our businesses. I can give you an example without going into business details. One of our companies imports material X from China and has maybe 12 suppliers, and it does something to that raw material, which actually makes it so the imported material makes it a little bit inflexible to transfer that same raw material between different clients. So what we realized is that just because of this, our working capital requirements were very big. So we needed to actually import quite large amounts of raw material because we couldn't really transfer the raw material between clients. But we're just in the process of investing into a machine that helps us make this transferability easier, which means we now, instead of importing in bulk, we can actually import every month, basically, and reduce our dollar needs. So what I can tell you is that it's a lot easier to ask $100,000 at once than $500,000 or $1 million. So we do all of these things to reduce the burden on FX. But yeah, I don't know. I hope that answers the question, but it's undeniably a challenge.
So definitely some innovative thinking on a day-to-day basis or a monthly basis is needed to be sure that you're able to meet these needs, but it's not insurmountable. I guess my next question, I'm going to come back to you on the regulations in our next round of questions and what it means for a fund like yours that could be going into another fund. But I guess the whole area of restricted investment sectors, you mentioned that pipeline is not a big deal or is not a problem for you, but how is the gradual opening up of these sectors? How is it grabbing you? Are there some key sectors that you're looking at? And you may not want to divulge, but is it giving you more excitement to be in the market at this time?
No, absolutely. For example, we had the latest company we invested in, which is a diagnostics business, in fact, was off limits for foreign investors. We did it just before the law, anticipating the law would change, and we had a short window because the previous owner was a foreigner himself, so we could do grandfathering. We could apply grandfathering rules on that. But what that means is now, given that clinics and diagnostics are also open for foreign investors, all the other things we could do as this business become much more flexible and plausible for us, which we're very excited about, because this business could grow into other kind of services that were previously off limits. I mean, we're also excited about telecom, but not as excited as some of the big brothers that we have around the block, because we don't have that capital to actually invest in the telecom industry. But we've been looking at some, what you can call, quote unquote, ancillary services around the telecom industry. These are, tower development could be, could be something. I know it's still CapEx intensive, but you can actually find, we believe that you can actually find local financing for that to develop it together. There's also, payment processing and other things that will come as a result of the liberalization of the telecom industry that we're looking at. Logistics and transport is something that we are probably not for this fund, but for the next fund looking into as well.
Okay, thank you very much.
So
I'll come back to you. Yes, thanks. I can feel that. And I'm sure your investors as well are also excited to hear all of this. So I'll come back to you in a bit, but let me go to Shanti. Shanti, again, thank you for the presentation, which was great. But what would you say are the top 3 things, Shanti, that are coming out for Ethiopia in this study? I mean, we've seen progress in regulations. Mesfin has spoken a bit about it. Ash has also spoken about what he sees as potentially, doing business. How do we weight certain aspects of it? But what do you see as the top 3 things coming out of this study for Ethiopia that, in the next medium term could be dealt with or could improve the ecosystem for PVC?
Yeah, that's a good question, because I focused on the issues in the ecosystem and not the areas of reform. What we believe in terms of top recommendations for the government are, one, this issue that I mentioned about the lack of institutional capacity and lack of understanding on private equity and venture capital, which can be really helpful as government entities interface with private equity and venture capital funds. So basically, sort of creating awareness around the industry and the value that it brings for government players, for policymakers, would be really good. Also to sort of reduce the transaction costs for private equity and venture capital funds by improving coordination between different entities that they have to deal with in the legal and regulatory environment. The second thing that we would say is Ethiopia has already, as has been discussed earlier, has already taken this very important and very favorable investment regime shift. We would go even further to suggest liberalizing the investment regime more, including, for example, opening the banking and insurance sectors, for example, which would be very attractive for private equity and venture capital funds. Very importantly, to address this this chronic issue around shortage of FX. That is really quite an impediment for all investors. And here the idea would be to review all the FX related regulations, and the government has already taken some steps. So I understand that there is a homegrown economic reform agenda, which is seeking to address the FX availability issue in the ecosystem. And the third thing I would mention is this issue of clarifying institutional investor guidelines. Now, obviously, the offshore funds operating in Ethiopia right now have not been impeded by the lack of domestic institutional capital so far, but we believe that the presence of local capital can be encouraging for other foreign investors, and it's from a development perspective, it's also a more sustainable form of capital for that asset class. So this is what I would say that we would say are the top priorities.
Okay, thank you, Shanti. I think that that kind of hits the point going forward. Shruti, I'm going to come to you now and just given that, you know, IFC SME Ventures has been leading these projects together with Shanti and her team because of our target markets for the IFC SME Ventures program. How do you see this result coming out of the Ethiopia assessment comparing to the other markets that we have assessed and some of the other markets that we're focusing our energies on?
Hi, Sam. Thank you for the question. Happy to take that. And Shanti, great presentation and great work. Thank you. Thank you for sharing that with us and for working on it. So Sam, the interesting thing about Ethiopia is it's a massive market. I mean, if you look at the population size, you know, it's significantly larger than the other markets that we've done similar studies for. For example, we did a study, I think around 3 years ago on Cote d'Ivoire. And my numbers could be a little bit wrong, but Cote d'Ivoire is around 25 million population. Ethiopia is around 100 million, right? So it's 4 times the size. But when we did the study for Cote d'Ivoire at the time, there were around 15 funds operating in Cote d'Ivoire. And this study shows us that around 15 funds operating in Ethiopia, right? The market is so much larger, which means that there is potential that is untapped, right? So for me, like relatively speaking, I think what it's telling us is that there's an opportunity here. Yes, there are obstacles. And the nice thing that the report does, it highlights the obstacles. So given the current government in Ethiopia and the changes that they're making to enable more business activity, I think it's a great time for this report to come out, because hopefully the obstacles identified would be recognized and there would be positive regulatory action as a response to this, which would then take the number of players in this market to a size that's commensurate with the size that the economy can be, right? And also, like if you sort of look at the GDP of Ethiopia, I mean, the GDP of Cote d'Ivoire today is significantly smaller than it is for Ethiopia. It's roughly half, right? Like Ethiopia is around 85 billion, give or take, and Cote d'Ivoire is around 45 billion, give or take. And so just comparing the two where we've done studies, there is a lot of opportunity in Ethiopia that I don't think is being adequately addressed. And I think, to me, that's the biggest takeaway from this report. And the thing that it also suggests is like the increase in activities happened in the past 5 years, right? Most of the funds that we see active have been active in the past 5 years. And even if you look at our own investment pattern, right, I'd say probably through our fund of funds program, our first investment in Ethiopia was maybe a little bit before 5 years ago, but the bulk of the money that we've seen deployed in Ethiopia has been in the past 5 years. So I think there's positive change. I think relative to the other markets that we've seen, I think Ethiopia is yet to grow into the size that it can be from a private equity perspective. But that also means that there's value to be captured by early entrants. And we're starting to see that. We saw that with the Afriflora transaction that KKR did. Hopefully we'll start seeing that with the transactions that Ash is working on. And we'll see that with the transactions that other funds that are in Ethiopia, you know, funds that we've supported, but also other funds that exist in the market. We hope to start seeing more activity. There was another recent exit. It was a secondary exit for a fund in Ethiopia, which was acquired by a more regional player. So we're starting to see more activity. And I think this report will give that additional comfort to investors who are starting to look at this and realize that, yes, there are challenges, but they are actors who know how to function within these challenges. And then they're able to work with companies, grow them, truly create value in the market, and then create value for investors.
Thank you very much, Shruti. I have a couple of follow-up questions, but I want to go quickly to Ash because he does have another engagement to tell us a bit about his views about doing things going forward. So,
sorry, what did you say?
So Ash, if you want to, yes, Ash, please give us a couple of things related to what you see regarding domiciles in Africa in general, and in relation to what we're seeing in Mauritius today, and more importantly, what it means for you as you look to do a follow-on fund.
Yeah, thank you, Sam. I'm so sorry. I don't know if I planned this wrong, but I had a meeting started 10 minutes ago. I'm just delaying that. So domicile is an issue. In fact, something that we thought was not a big issue when we started out, but as we have invested and looked at, some of the service. Domicile is, for those who don't know what it means for a private equity fund, is where you put your special purpose vehicles and also the fund in general, and then you have to have some great service providers providing tax, legal, financial advice, and also administration. This is very key for domicile. So I think on such a public forum, I wouldn't want to, pick a country and say this one is better than the other. But one thing I can tell you is that as a private equity firm active in Ethiopia or in any frontier market, we are cooking in two different kitchens. One is very, very, very messy, and the other one is pristine clean, and it's got the nice glass tables and a view of the garden and so on. That's the world of Shruti, which is, the LPs. They want some really nice reports. They want us to manage conflict, govern everything right. It's very nice.
And make money, Ash. And make money on the assets. Let's not forget that.
Okay, and make money.
And have impact.
So, what do you say?
And have impact.
Fantastic, and have impact. So while the kitchen we're actually operating in, so our business is in Ethiopia, they have a pretty messy kitchen. So balancing that is always very difficult. And what we would have hoped is that domicile, where actually some of the quality of the work that we do, not a whole lot, but a certain percentage of the quality of the work we do actually comes from the service providers in the domicile we're in. We would have hoped that they operated at the same nice, clean kitchen as Shruti's, instead of a bit of a messy kitchen, because I don't want to clean their kitchen and also clean my own portfolio's kitchen to make it very nice at the end, right? So that's the problem we're facing. So actually, we haven't made the decision yet. As you know, we eventually will raise a second fund in the near future. And my colleague who's working on that, he is telling me that he's increasingly looking at moving from our current domicile, just because there are just too many problems with service provision and so forth that we feel that we have enough to deal with, enough mess to clean. We would like everything to be so standardized and so efficient at the domicile level. Yeah, I don't know. I think you alluded to some kind of a move from current to another fund in Africa. I think there are some candidates that can really do that just because they have highly educated people and a long history of service, like accounting and other things. But I would take it with a grain of salt. I think it's possible, but somebody needs to be very careful around it.
Thank you. Thank you, Ash. So I guess, sorry, I was getting some feedback there, but let me just start. So Ash, I think that is very good. I will pick up maybe some questions from the participants, and we can have a talk about some of those a bit later. But thank you for staying on. I know you have another.
Thank you very much.
Yeah.
Thank you, Sam. Thank you.
Thank
Bye-bye.
you. Thank you. Bye. Yeah. So let me come quickly back to Mesfin. As Ash mentioned, you are really a linchpin in the Ethiopian market. You've been working and supporting the private equity sector from the beginning in a very long time, and so there's a lot of experience that you have about this. How will you be able to support? And I don't want to put you on the spot by picking a specific stakeholder, but in terms of both the good things you said about the regulatory side and the good things that are being adjusted in the private sector. What are some of the key things that you think you can do as a private sector legal firm to support this going forward? And maybe you can pick on one of the three things that Shanti mentioned we could focus on going forward. Mesfin.
Yes, thank you, Sam. I think I agree with Shanti as a lack of awareness both at a regulatory level, even when I see it, even at an investor level, that's a key problem. And so I think it's very important to set the agenda where it matters by engaging in a regular platform for discussion of the issue. I remember the local BDO office organizing a discussion on what's really private equity and its advantage. Of course, the discussants were private equity investors, and it was really a very eye-opening workshop. So, more of this would be important, and would of course participate in those by actually identifying issues and forwarding solutions. And it's also important to share this finding in the findings in this report. Two key organizations like the Office of the Prime Minister, the Ethiopian Investment Commission, the National Bank, and also the Ministry of Finance. These are very critical organizations which would have a say in taking ownership to fill in the regulatory gap and even see it as an agenda. So we would be part of that process. And also probably as a third point, there is already an ongoing law reform on the ground, as I indicated earlier. Right now, the draft commercial code is being discussed at the parliament, and then there is a draft capital markets and other laws, which we should find to be part of that dialogue with the institutions I mentioned earlier. Have to raise the issues as within the context of these reform initiatives. So probably, and finally also, there is on the ground, I really have very little understanding of it, but there is the 10-year plan that the government is currently discussing with stakeholders, and that consultation process, it should also be, the findings of this report, somehow have to figure into that. And in all of this, we can actively and proactively work with this platform by sharing our experience.
Okay, Mesfin, thank you so much for that, and I guess we can all count on you on what we do going forward in Ethiopia, and we will do what we can, I guess, to move this forward. But let me go back to Shanti, and then Shruti, I'll come back to you on how a bit more about on the investing side, since you spoke about making money and impact. Shanti, what are next steps in terms of what you see, not specifically for the World Bank, but generally what you see development institutions and also the World Bank doing to take this forward? Is this the dialogue with the government? What are the kinds of things that you see as a process in terms of taking this forward?
Yeah, thanks, Sam. And I think Mesfin actually hit on some of this in his answer right now to you, but I think the process generally is that once we share with private sector players, get feedback on the report, the idea is to disseminate and consult with the government on the findings of Diagnostic like this, and basically, as Mesfin was saying, sort of identify who are the key players or that can act as champions and potential counterparts. So the main mode by which development partners work on these issues would be through providing technical assistance. And we have, as you know, colleagues on the ground, regional colleagues on the ground in Ethiopia who have sustained long-term dialogues with the government of Ethiopia. They have a very good pulse on financial sector issues in Ethiopia, and where these kind of specific recommendations that we have in the study would fit in within the government's own agenda and reform program, their institutional and legal reform program. So as Mesfin said, those would actually be like great vehicles through which to incorporate some of the reforms of this kind of study. So that would be, from sort of a World Bank type of perspective, how to take forward the findings of this kind of a study. And then, of course, there are DFIs that actually invest in Ethiopia, and particularly in this COVID environment. I think their intervention in terms of continuing to provide capital and expertise can really sort of signal, can be a very positive signal in the market, showing confidence in the market. And basically, continuing to provide what DFIs seek to do, which is the demonstration effect. So yeah, that would be, I guess, our suggestion.
Okay, thank you. And would there be donors involved in this? Because I think that's also another dimension that, sometimes, between the investors, the World Bank is a very strong mainstay. Development finance institutions as investors are also very clear on what they want. But how do we bring in, donors as well, so that there's enough oomph behind this whole thing to get it to where it should be? Just a quick follow-on question.
Yeah, that's a good question. In fact, there are, so for example, the Dutch Good Growth Fund is already involved in the ecosystem. I didn't mention the early stage financing environment in my presentation, but basically they have been involved through providing grants that can actually, connect entrepreneurs to capital and sort of basically like support the early stage finance ecosystem. But yeah, you're very right in pointing out that there are donors with an interest in Ethiopia, and particularly in the private equity and venture capital space, that would be excellent partners for players like the World Bank, where we are well placed to actually provide technical assistance, but through their financing and strategic support. So part of our process would then also be to identify who those donors are and opportunities.
Okay, thank you, and we will follow up on that. Shruti, over to you. I guess in terms of how these discussions and these developments make it more comfortable for DFIs. You had highlighted the point about how Cote d'Ivoire has quite a number of PE players, has less of a size of market or economy. Ethiopia is showing very good numbers in terms of population and economic growth. I think one of the slides that Shanti shared showed I think up to about 10% GDP growth before COVID over the last 10 years. So do you feel, what are you hearing from other DFIs in terms of continuing or expanding their investments into Ethiopia, and given what we've heard today about the regulation?
I think Ethiopia is of high interest to investors. The challenge is on being able to repatriate exits from an investment, right? And primarily due to the convertibility restrictions on currency. And solving that problem, I think, would open the gates a lot more. So right now, when DFIs are considering investing in Ethiopia, if you look, most of the funds, most of the investors tend to be DFIs. There is, and then the other set of investors tend to be impact-oriented investors who really care about, making a difference. And so the mix of those two buckets is who you see active as primary sources of capital, funding either private equity funds or directly funding investments in Ethiopia. I think to be able to pull commercial capital in, the process of doing private equity transactions needs to get simpler. And investors need to feel more comfortable that, you know, an exit could happen and that they would get their money back, as opposed to, you know, an exit could happen, but then the money could get locked up in country because the dollars are not available, right? And so I think there are certain regulatory reforms that are required to really make change. But I think the potential of the market is what is making it more interesting for investors to consider. I also think as more deals are done in market, you know, there will be more players who would try to make exits easier. And with every, you know, private equity fund that is able to showcase positive returns, more capital is then encouraged to come into country, right? So you could have, I mean, the market in developed countries is very large, because from a regulatory point of view, there is limited obstacles, right? If you look at sort of growth rates and things like that for developed economies, it's much lower than most emerging economies. But the comfort that the regulatory environment provides encourages more investors to invest, right? It takes that risk element off. And I think that's the piece that we need to see more activity on. But there's less impetus for that change if there's no activity happening, right? Like if there was no private equity, nobody would really focus on trying to make a change. But as you start seeing, you know, oh, this company was, you know, $2 million top line, they got private equity investment, 3 years later, they were $10 million top line. They went from employing, you know, I don't know, 100 people to like 500 people. It created a lot of jobs. It's added to the tax income for the country. When you start seeing that type of impact, you know, the regulators also start taking notice, right? And so positive performance in private equity will be the biggest driver for these changes, because, you know, they want to be able to do more. Things are working out quite nicely. So, like, you know, can we make it easier? And I'm hoping that Ethiopia is on that path.
Yeah, thank you. So that sounds very good. Good times ahead for us as investors and Ethiopia as a country. Let me ask, I'm very mindful of time. We're almost out of time, but Esther, is there one or two top questions that you'd like us to deal? I can take it, and then we can try to answer it in the time that we have.
So maybe what I can do is just quickly go over the questions, and you can make that choice. So we have 7 questions on the Q&A tab. There's an anonymous attendee asked, how are exits by PE funds achieved in Ethiopia? Are there any success stories? And then we have Meseret Warner, who talks about what do you think will be the impact of the new regulations like the homegrown reform agenda? So this is a specific question on a regulation, I think, that has been introduced recently. And then we have Armias Eshetu, who speaks of, given the low penetration of PEVC, what do you think is the general sentiment and perception of potential targets here in Ethiopia about the industry? I think this has been spoken about in the conversations that you just had. Mesret also asked another question. One of the challenges we see is the relatively smaller ticket sizes demand of SMEs and larger ticket size supply by PE and VCs. How can this gap be bridged? And then the 3 last questions I see. One is by Biru, who directs this question directly to Mesfin. Have you seen IP being used as capital by a foreign investor in Ethiopia so far? How do you think the EIC will react if a foreign investor contributes a significant part of the $200K capital in the form of intellectual property? So that was a question for Mesfin. And then, oh, I see more questions are coming in. So, but one is a correction to Shruti. I would stand to correct Shruti. As a seasoned banker myself, the FX issue and repatriation exit issue is purely based on supply and nothing restrictive from policy angle. This is often misunderstood and curtails FDI with the notion that it is indeed an imposed policy restriction. In reality, there is no legal prohibition and all based on market demand stroke supply of FX. So Shruti, that was a comment directed to you, and maybe you'll have something to say about that. And then there's also another correction that has been made by Daniel Haile Georges. Minor correction regarding double taxation agreement. It is not 12 DTA because I have 20 DTA. So I think maybe that might have been directed to Shanti maybe. And the last question, what roles can other ecosystem players play to increase business growth? So this is inclusive of accelerators and incubators. So I hope you've been able to catch the questions I've asked, and maybe have one or two or three of them answered.
Sure. So I'll take I'll take the DTT question, and then I'll ask Mesfin to talk about IPS capital, and Shruti, potentially you can talk about the KKR exit to shed some light on this in the market. Unfortunately, we may not be able to answer all the questions, but I think this is a good indication of the interest in this. So just quickly on the double taxation agreements, and Shanti, correct me if I'm wrong, I think things may have moved since the work on this report was done. It was concluded in May, but a lot of the work was done, I think, last year and the lower half of 2018. So this could just be an evolution of progress, showing more progress in the market on the double taxation agreements, which is good. So Mesfin, if you have a couple of points on IPS capital in relation to the 200,000 contribution by entrepreneurs, and then I will come to Shruti.
Actually, this is just introduced in September with the enactment of the investment regulation. I would say this is yet to be tested. And there are, and AIC, of course, is used to requesting capital only in the form of contribution in kind or cash. So this just opens it up. And of course, there will be valuation issues, system issues, methodology that are acceptable for EIC. So this is yet, all I say is this is yet to be tested and be seen in practice. But the law has changed, it opened it up a bit.
Okay, thank you. So more progression there and potential to explore that further. So Shruti, do you want to come and talk a bit about the KKR, well, some of the exits that have happened in the market? And then we can, yeah.
Happy to. So on the FX issue, yes, it is supply demand driven, but it's the control is on the exchange rate, right? Because it's not freely convertible. Like if you could pull more money out versus bring more money in, or do the reverse, the exchange rate would be impacted. And that's what happens in most open economies, right? With Ethiopia, the desire to control that exchange rate limits how much money can move in and out. And so oftentimes from an operating perspective, there's, how much dollars you bring in is where you get access to take out. But when you're selling a stake in the business, it is a financial transaction. It's not an operating transaction, right? So it doesn't move in the same way. And so what you tend to see private equity firms do to sort of avoid the situation of, finding a buyer for a stake in the company, but then not being able to take that money out of the country because, let's say, the flour business that year hasn't been as good, agriculture, coffee, commodities, the export-oriented, hard currency-oriented industries in Ethiopia for that year haven't been as strong, then that challenges how much money can go out of the country, right? In most other markets, you don't have those limitations. And so with private equity, oftentimes what they tend to do is they will set up a holdco, and I think Ash spoke a little bit about this. They set up a holdco in overseas jurisdiction, And when they exit, they sell the stake in the overseas holdco just to not get entangled in this process. So the deal that Sam was referring to was an investment that KKR made in a company called Afriflora. And they eventually sold it to another private equity firm called Sun Capital when KKR decided that Africa wasn't providing enough pipeline for the size of transactions that they wanted to do. And so the way they exited was the sale of the overseas holdco. And that is the sort of talked about exit in Ethiopia. We're yet to see a private equity firm invest in a local company and get an exit from a local company and then be able to repatriate those funds to investors. So the person who raised the issue on the FX is absolutely right. It is, a demand supply controlled process, but in other markets, the currency movement is freer. So that's the key challenge. Yeah, back to you, Sam.
Thank you very much, Shruti. That's very useful. So I'll just put in one last comment, and then I think we have to wrap this up. The question on ticket size, I think, is relevant, but it's also a pointer to the fact that, as Ash said, there's quite a bit of pipeline. Of course, you will definitely have investing vehicles positioning themselves according to their strengths. So I think as the market develops in Ethiopia, you continue to see fund managers or investment vehicles coming in and deciding, look, I want to focus on the $50,000 to $250,000 range. I want to focus on up to 500,000, whilst the other investors may also focus on higher ticket sizes. So just to point out that is a relevant question, but as the market develops, we'll continue to have expansion into the market. So I think on that note, we've gone beyond our time, and thank you all for the wonderful participation, especially to the panel. Mesfin from Mesfin Tafesi and Associates, Ashanafi, who has left, but from Zoskalis Partners, which is a fund investing in Ethiopia, Shanti Divakaran, who led this study from the World Bank, Shruti Chandrasekhar, IFC, SME Ventures, and to Esther, I don't know if you want to say a few words, but to Esther and the East Africa Venture Capital Association, you've been a great partner in this and other things, and we look forward to continue working with you. And to all the participants who joined, thank you so much. We had hoped to have an online version of the report available for participants today, but we're still going through final cleaning up of the report and making sure we have all the kinds of approvals we need to make it available online. But once it is cleared, we will have it cross-posted between the East Africa Venture Capital Association websites and potentially the SME Ventures website as well, so people can have a better read of it. So once again, thank you very much, and we hope to engage again soon. Thank you.
All right, and also thank you to Sam for moderating the panel discussion. We're really, really appreciative and delighted to have collaborated with you as the EAVCA this afternoon or morning, wherever you're from. And as Sam has mentioned, we will share the link to the report once it's ready, but also a link to the recording of this session that we've just held that will be posted on the EAVCA website and on the EAVCA YouTube channel. And a link will be shared to all the participants. In the meantime, I wish you a fantastic rest of the day, and we look forward to engaging again soon. Oh, bye-bye.
Thank you.
Thank you.